Everybody is looking for answers about the market's future, why the U.S. Federal Reserve might be planning an emergency rate cut to address a potential market crash. We'll explore why such a move is necessary, the current plans in place, the pressure from investors, and historical precedents. Let's get started. Why are there not more people talking about the current economic indicators? Various economic indicators are flashing warning signs. Inflation rates are rising rapidly, eroding the purchasing power of everyday consumers. GDP growth is slowing down, indicating that the overall economic activity is losing momentum. Unemployment rates are creeping up as businesses struggle with increased costs and supply chain disruptions. These disruptions, partly a lingering effect of the pandemic and geopolitical tensions, have led to shortages and delays that hamper production and distribution. In the financial markets, we're witnessing significant volatility. Stock prices are swinging wildly as investors react to the latest economic data and news. Consumer confidence is taking a hit as people grow more pessimistic about the future. There's also been a noticeable increase in demand for safe haven assets like gold, as investors look to protect their wealth from potential market downturns. All these factors are impacting everyday people. The cost of living is rising, making it harder for families to make ends meet. Finding a job is becoming more challenging as businesses cut back on hiring or even lay off employees. And for those with jobs, their paychecks don't stretch as far as they used to, reducing their ability to spend and save. Let's delve deeper into these economic indicators and understand their implications. I don't think people understand how serious inflation is right now. Prices for goods and services have been increasing at an alarming rate. This surge in inflation is driven by several factors including supply chain disruptions, increased demand post-pandemic, and rising commodity prices. As a result, the purchasing power of the average consumer is being eroded. People are finding that their money doesn't go as far as it used to. Everyday essentials like food, gasoline, and housing have become more expensive. This puts a strain on household budgets, especially for those on fixed incomes or low wages. I don't think people understand how critical GDP growth is to our economy. When GDP growth slows, it indicates that the economy is losing momentum. Several factors contribute to this slowdown. Businesses may be cutting back on production due to higher costs and supply chain issues. Consumer spending, which is a significant driver of GDP, may also be declining as people become more cautious with their money. This slowdown in GDP growth is concerning because it can lead to lower business revenues, reduced investments, and eventually, job losses. I bet you didn't know how rising unemployment rates can impact the economy. When unemployment rates rise, it means that more people are out of work and looking for jobs. This can happen for various reasons. Businesses may be laying off workers to cut costs, or they may be hesitant to hire due to economic uncertainty. Higher unemployment rates lead to decreased consumer spending as people without jobs are less likely to spend money on non-essential items. This in turn affects businesses and can create a vicious cycle of reduced economic activity and further job losses. I bet you didn't know about the massive supply chain disruptions. Lockdowns and restrictions led to factory closures and reduced production capacity. Even as economies began to reopen, the supply chain has struggled to catch up with the surge in demand. Additionally, geopolitical tensions such as trade disputes and sanctions have further complicated the situation. These disruptions have led to shortages of essential goods, delays in production, and increased costs for businesses, all of which contribute to higher prices for consumers. I bet you didn't know why an emergency rate cut might be necessary. Many are advocating for the Federal Reserve to implement an emergency rate cut. But why is this necessary? First and foremost, an emergency rate cut can stimulate economic growth. By lowering interest rates, the Fed can make borrowing cheaper for both businesses and consumers. This can encourage businesses to expand their operations, hire more workers, and invest in new projects. For consumers, lower interest rates can make it more affordable to buy homes, cars, and other big-ticket items, which boosts spending and in turn, supports economic growth. Am I the only one that didn't know how powerful lowering interest rates can be on economic activity? When borrowing costs are reduced, it becomes more attractive for businesses to take out loans for expansion, purchasing new equipment, or investing in research and development. These activities can create jobs and spur further economic growth. For consumers, lower interest rates can mean lower monthly payments on mortgages, car loans, and other types of credit. This can free up disposable income, which can be spent on goods and services, further stimulating the economy. I don't think people understand how crucial managing debt effectively is. Many businesses and individuals carry substantial debt loads, and the burden of servicing this debt can become overwhelming, especially in tough economic times. Lowering interest rates can ease this burden, preventing a wave of defaults and bankruptcies that could further destabilize the economy. When interest rates are lower, the cost of borrowing decreases. This means that businesses can refinance their existing debt at lower rates, reducing their monthly interest payments. Similarly, individuals with credit card debt, student loans, or mortgages can benefit from lower interest rates, making it easier to manage their financial obligations. You need to hear this if you're an investor. By implementing a rate cut, the Fed can demonstrate that it is taking proactive measures to support the economy. This can help stabilize financial markets, restore investor confidence, and prevent panic selling. When investors see that the Fed is willing to take decisive action to support the economy, they may feel more confident in maintaining their investments, rather than selling off assets in a panic. This can help prevent a market crash and maintain stability in the financial system. Why are there not more people talking about the Fed's current plans? Although no official announcement has been made yet, the Fed is actively monitoring key economic indicators to gauge the severity of the situation. They are paying close attention to inflation rates, GDP growth, unemployment figures, and financial market conditions. This data helps the Fed determine whether an emergency rate cut is warranted. The Fed has a team of economists and analysts who are constantly monitoring economic data. They look at a wide range of indicators, including inflation rates, GDP growth, unemployment figures, consumer spending, and business investment. By analyzing this data, the Fed can get a comprehensive view of the economy's health and identify potential problems that may require intervention. The Fed is also in regular communication with various stakeholders, including financial institutions, businesses, and government agencies. These discussions help the Fed assess the impact of current economic conditions and gather insights from different sectors of the economy. For example, the Fed may hold meetings with bank executives to understand how lending activity is being affected by current interest rates. They may also consult with business leaders to gauge the impact of supply chain disruptions and rising costs. While we don't have specific details on the exact timing or magnitude of a potential rate cut, reports suggest that the Fed is prepared to act swiftly if conditions worsen. They have contingency plans in place and are ready to implement an emergency rate cut to support the economy. This means that the Fed is closely monitoring economic data and is prepared to take action if necessary. They may hold emergency meetings to discuss the situation and make a decision on whether to cut rates. I bet you didn't know the pressure investors are putting on the Fed for a rate cut. Investors are deeply concerned about the potential for massive losses in their portfolios if the market continues to deteriorate. A rate cut could help stabilize asset prices, providing some relief to investors and preventing a further decline in market value. Investors are concerned about the potential for massive losses in their portfolios if the market continues to deteriorate. A rate cut could help stabilize asset prices, providing some relief to investors and preventing a further decline in market value. Lower interest rates can make stocks more attractive relative to bonds, as the return on bonds decreases. This can help support stock prices and prevent a market crash. Moreover, investors are looking for ways to hedge against inflation. With inflation eroding returns, they need strategies to preserve their capital. Lower interest rates can make borrowing cheaper, encouraging investment in growth sectors that offer higher returns. For example, lower rates can make it more attractive to invest in real estate or technology stocks, which may offer higher returns than traditional bonds or savings accounts. Investors also remember previous crises and the role rate cuts played in mitigating damage. During the 2008 financial crisis, the Fed's rate cuts were instrumental in stabilizing the economy and financial markets. Similarly, during the COVID-19 pandemic, the Fed's swift action helped cushion the economic blow and supported a quicker recovery. These past experiences are influencing current demands for preemptive action to avoid severe consequences. Investors believe that a rate cut now could help prevent a more significant downturn in the future. This is going to blow your mind. During the 2008 financial crisis, the Fed slashed rates by a total of 500 basis points, bringing the federal funds rate from 5.25% in September 2007 to a range of 0 to 0.25% by December 2008. These measures helped stabilize the financial system and eventually led to economic recovery. The 2008 financial crisis was one of the most severe economic downturns in recent history. It was triggered by the collapse of the housing market and the subsequent failure of major financial institutions. In response, the Fed took several measures to stabilize the economy, including cutting the federal funds rate by a total of 500 basis points. This brought the rate from 5.25% in September 2007 to a range of 0 to 0.25% by December 2008. These rate cuts helped lower borrowing costs, stimulate economic activity, and restore confidence in the financial system. Over time, these measures contributed to the recovery of the economy. Similarly, after the dot-com bubble burst in 2000, the Fed reduced rates from 6.5% in early 2001 to 1.75% by the end of the year. The dot-com bubble was characterized by a rapid rise in the stock prices of internet-related companies, followed by a sharp decline. When the bubble burst, many tech companies went bankrupt, and the stock market experienced significant losses. In response, the Fed lowered interest rates to stimulate economic growth and prevent a prolonged downturn. The rate cuts helped support business investment and consumer spending, which contributed to the eventual recovery. More recently, during the COVID-19 pandemic in 2020, the Fed implemented 2 emergency rate cuts in March, totaling 150 basis points. The federal funds rate was reduced from a range of 1.5 to 1.75% to 0 to 0.25%. The pandemic led to widespread lockdowns and economic disruptions, causing a severe contraction in economic activity. The Fed's swift action in cutting rates helped cushion the economic blow and supported a quicker recovery. The lower rates made borrowing cheaper, which encouraged spending and investment. Additionally, the Fed implemented other measures such as quantitative easing to support the economy. These historical precedents highlight the potential effectiveness of rate cuts in addressing economic crises. They demonstrate how swift and decisive action by the Fed can help stabilize the economy, restore confidence, and pave the way for recovery. I bet you didn't know the risks and criticisms of emergency rate cuts. While an emergency rate cut might seem like a panacea, it's not without its risks and criticisms. One significant risk is the potential for hyperinflation. Lowering rates could fuel inflation further, exacerbating the problem rather than solving it. This is a delicate balance that the Fed needs to manage carefully. Lowering rates could potentially fuel inflation further, exacerbating the problem rather than solving it. This is a delicate balance that the Fed needs to manage carefully. If rates are lowered too much or too quickly, it could lead to runaway inflation, where prices increase rapidly, eroding the value of money. This would make it even harder for consumers to afford basic necessities and could lead to social and economic unrest. Another concern is the reduced efficacy of rate cuts over time. With rates already at historically low levels, the Fed has less room to maneuver. Constant rate cuts may diminish their impact, making it harder to stimulate the economy when needed. If rates are already near zero, cutting them further may not have a significant effect on borrowing and spending. This could limit the Fed's ability to respond to future economic crises. There's also the issue of moral hazard. Frequent interventions by the Fed might encourage reckless financial behavior, with investors expecting bailouts during tough times. This can lead to a cycle of risk-taking and instability that undermines the long-term health of the economy. If investors believe that the Fed will always step in to support the market, they may take on excessive risk, leading to asset bubbles and financial instability. This is going to blow your mind. Many believe that an emergency rate cut by the Federal Reserve could be a vital step in preventing a market crash. By lowering rates, the Fed can stimulate economic growth, reduce the cost of debt, and restore market confidence. However, it's essential to consider the potential risks and ensure that such measures are part of a broader, more comprehensive strategy. Stay tuned to Success Dude for more updates on this developing story and other financial news. Don't forget to like, share, and subscribe to our channel for more insightful content.